Hi, how are ya? We all know that everyone likes to overcomplicate things, and this is especially bad in the finance and the trading world. Without any further ado, whatever ado means, let's distinguish between supply and demand and support and resistance without rambling for 20 minutes and somehow not managing to say a single useful thing the entire time. Sorry, been watching too many trading videos. First, let's make something really clear. I'm not trying to sell you a course, so I'm not gonna lie and pretend like these two things are way different from each other. Nope. The problem with answering this question is that these two ideas are fundamentally different. Apples and oranges. It's like wondering what the difference is between the Minimax principle and meatloaf. Huh? Well, it's a little closer. But supply and demand aims to explain why prices move. It's an explanation. When something gets to a high price, the laws of supply and demand state that it will be sold more. Another way of wording this is that selling pressure will increase. When something gets to a low price, the law states that it will be bought more, or buying pressure will increase. When it's in the middle between expensive and cheap, there is balance in price. Supply and demand are in equilibrium. The only thing that means is that both sides, the bulls and the bears, have reached a state of balance. They agree. They're thinking, yeah, I suppose that's fair. But then, out of nowhere, like a tsunami, a giant wave of bears wash over the shore, and the price floods all the way into the resort hotel, which is fully loaded with bulls, and they charge out towards the bear flood, and they smash it all the way back to the ocean of balanced price. Then, the ocean returns to its previous state of ebbing and flowing. Sally sells sea bear shells at the sea bull shore. Got it? No? Me neither. The price goes like this until it gets high enough that people want to sell it, or it gets low enough that people want to buy it. Don't let anyone tell you it's more complicated than this. Salesmen like to overcomplicate it, and then offer their courses as the answer to your confusion. Then, we have these zones where the price is supposed to repeat its behavior, because hypothetically, the big money players who move the market should find the same value here that they did before. For example, perhaps they find selling value from $22 to $24, and they find buying value from $15 to $17. So, it could go up or down starting from anywhere between these prices. We're not talking about exactly at 24 or exactly at 15. We're talking about a range in price where value is found. One belief is that these zones have leftover orders that didn't initially get filled because the price moved away too quickly. Unlikely. Sorry, had a load of bull stuck in my throat. And I'm not talking about bulls and bears. I'm talking about bullshit. Next topic. More likely, if price repeats the same behavior, it's because the people who made it move are going to take that trade again, because the reason they took it in the first place still exists. I'm talking about probability. I'm not saying that's impossible. Hardly anything is linear or binary in the markets. But there are explanations that make more sense than others. So, whether or not there are actually leftover orders, or if it's just because these areas still have the same value, this is the explanation for why the price will repeat its behavior. Moving on. Support and resistance is a description. It says, this has happened. It doesn't try to explain why it did what it did, which is what distinguishes it from supply and demand. There is no law of support and resistance. When support goes down, it doesn't mean resistance goes up. There's no symbiotic relationship going on here. Don't worry, I don't know what that means either. It sounded smart when it popped into my head. Sometimes I like to say big words to make myself sound more photosynthesis. Anyways, for supply and demand, we have zones where buyers and sellers find value. The only thing support and resistance does is show us a horizontal or sloping trend line that the price is struggling to break through. Be very hesitant of trading these lines though. Let's think about this for a second. There are so many factors, arguably incalculable, that go into making the price move. Don't you think there's a good chance that sometimes when we see these magical lines that aren't being broken, that some of them have happened due to pure chance? Yeah, of course some of them are real and are actually happening for a reason. But have you heard someone say that the more touches on a support or resistance line, the stronger it is? Hold on, how does that make any sense? How could something possibly become stronger the more times it is hit? Each time it gets hit, let's say that the orders are being absorbed each time, so clearly it's going to run out and become invalid, right? Each time I throw a rock at a window, the window does not become stronger. I don't say to myself, wow, this window is showing some clear resistance, throw a rock at it, and then think, oh my god, it's getting stronger. The more time the price hits the same level of support or resistance, the less likely it is to repeat its previous behavior. If you prefer the car analogy, that translates to, each time I throw a rock at my car's window, it's more likely to break. But guess what? That doesn't mean that all of a sudden the price is going to rocket up after finally breaking resistance. It might go 5 points further and then plummet. A retest of prior resistance doesn't always mean it's going to go up. The course sellers will say, well, there were other factors at play. Or, yeah, duh, of course it wasn't going to work that time. Didn't you see the reverse shark tooth inverted triple waterfall volume pattern? Buy my course. I'll teach you about it. Sometimes things just don't work, and there's nothing we can do about it. The truth is that there are no 100% accurate systems, and even the best ones don't always work on an A-plus setup. If we're watching the price move, and the thought that comes to our head is, this is either going to go up, down, or sideways, we should probably take that as a sign that maybe we should just wait this one out. Most aspects of technical analysis have as many, if not more, examples that show them not working as they have examples of them working correctly. Perhaps there is too much uncertainty to justify making a trade purely based on support and resistance, which is a conclusion that many traders come to after they mess it up. All of us have done that. Sometimes we do something really stupid and get stopped out, which then makes us realize that our decision to take a trade with a 33% chance of working was dumb. I say 33 because this is referring to setups where the price gets to an important price level and it seemingly has an equal probability of resulting in one of the 3 possible movements: down, up, or sideways. Using market context, we can use math to determine which directional movement is more likely. When we can't, because it's too choppy, some of us will be better off just watching it rather than trading it, like me, for now. Support and resistance is not a standalone trading system. Like all aspects of technical analysis, they are better to be used as references rather than systems. Now, that 33% success rate doesn't necessarily mean it's a bad thing. If you can get a perfect entry on a trade, where the logical stop loss is extremely close so you are risking very little, then that trade has a very high reward and a very low risk. That's when it becomes a good setup. Trading is such a complicated, specific, and situational thing that you should never trust anyone who tells you blanket statements about trading setups as if the market can be easily predicted. That's why I continue to gravitate towards trend trading. My trading strategy is based on following what's happening and trying to sit on my hands on the days where the market can't make up its mind. Although, I don't get to practice as much as I wish I could because of college. But that will be over soon. I like to think of it as playing follow the leader. When I was in high school playing varsity soccer, my coach said to me, "Isaac, I need you to step up and be a leader." I said to him, "Coach, without followers, there would be no leaders." Then he benched me and I barely got playing time. You may be wondering why I'm sharing this. Good question. Moving on. We've established that supply and demand zones are where buyers and sellers find value, and the idea itself tries to explain why prices move. Support and resistance only shows us where the price can't seem to break above or below. These levels can be horizontal, or they can be at a small slope. Generally, it is said that the steeper the slope, the less powerful it is. But it also used to be said that Mercury gave you immortality. You could ask those people yourselves, but they died. So be careful about those beliefs. Take everything you hear with a grain of salt, whatever that means. Your best education will come from looking at price charts yourself and doing the hard work of realizing that every time you think of a new idea for an unbeatable system, it immediately loses. Come join the club. I put in hundreds, if not thousands of hours into educational YouTube videos before I figured out that I was better off just staring at the screen and watching the price move. At one point, all of my dreams were stock market related because I was even watching them before I went to bed. That was also my wake-up call to chill out a little. Use these videos in conjunction with screen time, otherwise everything here is just hypothetical. This is why I like playing follow the leader. I don't try to guess when the price is going to turn around or do something crazy. I just follow it up and down and get out when it looks like it's had enough of going that way. Counter trend trading requires an absurd amount of hours in the market because reading the price has to become a part of you, which is a skill I don't have yet. Take a look at this choppy McChoppy chart. For the most part, support and resistance only makes sense when the market is trading sideways. If you're looking at this and seeing how many times the price bounced off of support and went back up, and thinking to yourself, if I just buy there and sell a couple candles later, that's a good strategy. Sure, it's what my brain does too, because like you, I'm also human. Crazy, I know. It actually went through it more times than bouncing right off of it though. So instead of thinking of support and resistance as a trampoline, try to think of this in terms of mean reversion. For those who don't have a psychology or statistics background, mean reversion is basically just the tendency for something to go back to its average. So, one idea is that when the price breaks its range, those can sometimes present trading opportunities because we can expect the price to return to the mean with a statistical level of significance. Most of the trading and movement happens in the middle of this range, so we can trade the big moves out with the hope that they return to the mean, which is just the middle. Of course, and this is financial advice, eventually ranges will break. So, I guarantee that one of the times you try to catch the falling knife or slap the rising balloon back down in hopes of mean reversion, it won't work. That's just reality. This is why it's better for some people to not trade range-bound markets. Some people are very good at it though. It just requires a lot of practice. So, if you're new, like me, don't use your real money. Do simulated trading so you can understand movements in your system, and then go to very small positions so you can begin the long process of numbing your emotions, which is called systematic desensitization. Notice that the top line is sloped. You may have also noticed that it would have been hard to figure out when to take profits if you got into a position during a movement out of the range. You can either hold for a long time and reduce your chances of profit, but have big winners, or you can take small winners with a high success rate. We dream about that giant winner, that home run trade, but collecting a ton of smaller winners and rarely losing is much better on our emotions. Here's the same picture, but the top line isn't sloped. Our brain automatically analyzes it to seek different patterns. It's also important to keep in mind that support and resistance is easy to look back on, but not so easy to trade on during real time. We're looking at a range that has already happened. So, not sloping the line as much gives us more opportunities to take trades that are based on mean reversion. We don't know that the market is range-bound until it's already done it a couple of times. So try to keep your brain from thinking that there were perfect trading opportunities in the beginning. Most people who do videos on this stuff only show the perfect examples. But, as I've said, I'm here for the truth, even if it can be slightly discouraging at times because it shows how complicated trading really is. This is what happened later that day. This was October 27th. I was paper trading and did really well with my follow the leader strategy during that massive dive at the end. It's possible to trade ranges, but it's easier to say buy at the top and sell at the bottom than it is to actually do it. As you can see, it doesn't go up and down to the same place every time, so it's up to you and your own risk tolerance to figure out where you want to get in and get out. Get in too early with too small of a stop loss and you'll get stopped out. Get in too late and the move will reverse on you. Shout out to those of you who remember the phrase, don't diddle in the middle. That giant collapse at the end happened very fast. With a tick chart, you can tell that the volume is increasing because the time between the candles decreases. We're looking at a 1750 tick chart, meaning each candle has that many transactions before making a new one. It's not an exact way of using volume, but it's more helpful to me than it is to have a volume histogram at the bottom. So, hopefully this cleared some stuff up. It took a while to make this, but it's fun for me. Remember, making educational videos and selling a product about that education is a recipe for biased information. It's a huge conflict of interest. Just be vigilant out there. For any questions, leave them down below. If you want to talk privately, follow me on Instagram at iManTradingFutures with my YouTube logo as the picture, or you can find my email in the About section on my channel. Take care.